description, but I kind of got started into real estate right out of college. Just buying a primary residence. It was like a 6-bedroom house though, so it's wicked big. It had like two. It was an old duplex, I think, that got converted to a single family home, and yeah, it had like 2 living rooms. It had a 2 balcony, or like a balcony on the front, first floor ish, and then or patio, and then upstairs second balcony. But yeah, I bought that 6-bedroom house in Kansas City for 160-ish, like right out of college, and then didn't think I was going to sell it for a while, but a couple of years later the real estate market got hot, so I ended up selling that property for like 200K. And I was also kind of house hacking and living there almost like rent free, just renting out some of the spare bedrooms. And then that's when I was like, hey, this real estate thing is like pretty cool, living for free and making some money. I was like 40 grand was like a year's salary. I was making just like a little bit over that on my first job out of college. So getting into, like real estate a little bit more, I turned that first property into an Airbnb, and that Airbnb did like really well. It was actually an Airbnb before I bought it. I was making like 3 grand a month. And so I was pretty happy about that, because like my mortgage was like 1,500. And then, so I left my like job doing startup sales for like this tech company, because I was making as much from the Airbnb as I was making from my base salary there. I was just like, why would I keep wasting my 40 hours a week there, when the Airbnb could kind of support everything? So I started doing like the Airbnb, didn't really know what I wanted to do, dabbled in like financial advising, which is really just life insurance sales. And after, a handful of meetings, like I probably did like 50 or so meetings, and people would ask me like, what would you do if you're in my shoes? And I was like, I'd buy real estate. Like if you don't have dependents, you don't really have a need for life insurance. Life insurance as an investment, not that great, not the most liquid. And it just wasn't, I didn't really agree with selling it as investment. So I was really bad at my job as a financial advisor. And then my real estate agent who helped me buy my first house, second house, and investment property, her husband became a lender. And I was like, I want to figure out more of this financing, game, and kind of figure out how to structure my own portfolio as an investor, right? How do I work the rules? How do I, bend the financial system to my will, so to speak? So I was like, yeah, lending. I got my degree in finance. So it was kind of like right up my alley. It just made a lot of sense. And then kind of dove into it. And now actually, so I'm partnered with a huge kind of investor group here in Kansas City. The Facebook group has like 9,000 members. If any of you are even thinking about investing in the Kansas City market, I would definitely join this group, because this group has all the realtors, all the contractors, the lenders, the agents, pretty much all the real estate, like most of the 9,000 people I would say are in Kansas City. But I work with a lot of
What's
investors.
the Kansas, what's it called? What's the group called?
It's called, let me see, Bridge Real Estate Investing Meetup is the name of the group. So it's, let me see how many, it's like 9.8K members. Yeah, it was featured in a couple real estate magazines, or so I'm told. Like it was one of the fastest growing real estate groups on Facebook. And I mean, there's a lot of out-of-state investors that are in this group too. But so basically, like the setup with the new company I'm with is like we're actually directly partnered with Bridge, and Bridge is the company that started this group, but they are a turnkey company. So they buy and flip properties. I think in 2019, they did like 150 flips in 2019. So they have a massive operation. And obviously starting this group is like good for them, because it gets them out-of-state investors or contractors, if they're shorthanded. But now I've like majority of my loans are investment loans. I deal with all sorts of different types of investors. I've got my, your regular like W-2 investor, where they've got great stable income and they're just buying rental properties for their retirement. I've got people doing the BRRRR strategy and seeing the BRRRR strategy from the financing side. Definitely if you have the fortitude or the gut to go do the BRRRR strategy and get your hands dirty with some flips, like that is definitely kind of what like my number one recommendation. And I can explain a little bit more about the financing and like how it all works on the back end of why it's kind of like beautiful whenever I go through my loan process of like how everything ties together and all the debts basically get canceled out by the lease agreements. So then they can just basically recycle their funds over and over. It's almost poetic in a way.
All right, Angelo, slow it down.
What? Slow down?
I was gonna say, slow down, Michelangelo.
Yeah, no, it's it's pretty fun, but I mean I've also dabbled in a lot of like the non-QM loans. I don't really do too many of them. It's not.
Could you explain QM loans? Sorry.
Yeah. So QM is qualified mortgage. So that's all of your traditional stuff that falls into like the Fannie Mae, Freddie Mac, in like buckets where it's like your cookie cutter. You walk into a bank or your mortgage lender, and you just do like your traditional. We might call those like full doc loans. So full documentation. I need your tax returns. I need I need bank statements. I need every kind of documentation you basically have. If you have businesses, then I need your LLC docs, articles of incorporation. I need your profit loss statements, your balance sheet for your businesses, business tax returns. Like it's pretty thorough. That's a QM qualified mortgage. Non-QM is all of the specialty stuff that I guess this group probably really wants to know. Honestly, as a lender, it's less profitable, or it's not really worth my time. I'm thinking maybe I might change models, focus more on retail, but find out a way to where it's a good use of my time, because like we'll get paid less on those loans, and we have to broker them out to specialty lenders. So like a big one you might know of or might not know of, they're national, is Angel Oak Investing. If you want to look them up, Angel Oak is actually who we used when I worked at Loan Depot, which is like a huge behemoth, mega lender. Like they did, I think like $40 billion in loans last year or something crazy. But anytime we would have like a weird investor, we would try to pass them off to Angel Oak. But like the reason why lenders don't like to use them is like it's out of our hands. It's not our underwriting team, it's their underwriting team. We're dealing with their account executive who's basically trying to sell us on pushing more customers their way, and we get paid half the commission we would normally get paid because we're splitting it with them. And it's messier. Any delays hurts our reputation more than like Angel Oaks, because nobody cares about Angel Oak. They care about the guy that they went to for the recommendation in the first place. But there's some creative stuff you can do. I guess to kind of outline a few of the loan programs, two of the best loan programs in like non-QM world that this group might really like. So one is the bank statement loan. Anybody that's self-employed, if you're like a real estate agent or you own a business and your tax returns aren't great for a qualified mortgage, a QM conventional mortgage, because you deduct out the wazoo for your taxes, so you're not paying Uncle Sam, but then you have very little income to show the mortgage lender. They can do a bank statement loan, which looks at your last 12 months or 24 months bank statements, and they can usually derive like double the income that you show on your taxes, because they're not looking at all the deductions you take, right? So say you made like 100 grand, like really, but on your taxes you're showing 40 grand in income, right? Because you do a bunch of deductions, but your bank statements will show closer to that 100 grand. And so they looking at your bank statements. Now, the more bank statements you provide, the better your rate. So if you do 24 months of bank statements, right, that's lower risk for them. You got a better rate. All of these, I mean, I would say ballpark rates on products like this is closer to your like mid fives. So it's kind of that happy medium between hard money lender and then your conventional, where hard money lenders ask for the least amount of documentation. They might not even ask for your 12 months bank statements, but they're going to charge double-digit interest rates like almost every time. They're going to charge. I had a meeting last week. They said their interest rates were like 15%, but right, their investors do not care about the interest rate because they're savvy flippers and they're only going to hold on to it for 2 months anyway before they flip it and get out of it. So they want their money fast. That's why they work with hard money lenders. But this bank statement program is decent for the self-employed. And then the other really popular program that I talked about a lot, but like I didn't actually do a bunch of them, was the cash flow loans is what we call them. And essentially they're less concerned. They don't even collect income documentation from you, right? This is where they are only looking at the property. And if the property's rent cash flows, if the rent will cover the mortgage and then some, I think by like 20% extra is what they were looking for. So pretty much every single one of your 1% deals would qualify for this, but it doesn't even have to be that good. Most of the time, right, unless you're like coastal states, your rent should cover the mortgage. And as long as your credit score was like 640, and you'd still have to do like 20% down, but the income questions go away because it's more asset-based lending, right? They're like, hey, what does the property look like? What's the property gonna do? So that was another interesting product that I was like really excited about. And then I was like, oh shit, it's just not worth my time to really sell it. Okay, shoot, I missed maybe some questions. Weird investor, please clarify what type of loan product. Oh, okay, the 1% thing. So the loan product was called cash flow loan, or at least that's what they called it if you go to like Angel Oak's website. And they actually, I don't know, the pandemic happened and then they got rid of like their bank statement stuff. Let me see if they have the bank statement mortgage. Yeah, they still have their investor cash flow loan. Let me see if I'll just post their link. And yeah, 5.5% is for 30-year loans typically. So they're doing full 30-year AMs, which is nice. I just posted a link to Angel Oak. Although if you want to go through me, I could get you the same thing through Angel Oak, but then I get some commission as well. But I'm just putting that out there. You can go directly to them. Weird investor. Did I say weird investor? Investors can get, I guess, very diversified in like the types of investors that you deal with, right? Like I think when I talk about weird investor, I might just be talking about the self-employed investor and not the W-2 super easy to process investor. How fast is the close on these loans? They say 30 days, but like sometimes they would take 45 days. And that's why I was told, at least by my old branch manager, like he stopped referring stuff to Angel Oak because it would take them 60 days. When they said they would close in 30 days, there's just delays and delays, and he's like, the hell no, like, and that's why like it would hurt our reputation, right? Like I'm like, yeah, we can get it done. We'll broker it through this non-QM lender, Angel Oak, down in Florida, right? And we've got this specialty product, and then it's like, and then we look like idiots because people are asking us like, oh, like what's the status of the loan? I was like, I don't know. I have to refer back to what their team is doing, what their underwriters are doing. So I don't know, but actually some discussions I've had with people that are like trying to recruit me, and we're talking about, these products, because the interest rates on conventional investment loans, I don't know if you guys saw, right, the announcement from Fannie Mae that they're putting a hard cap on the amount of loans basically that they're taking to, I can't remember if it was like 7% or 10%, but there's a cap on the amount of investment loans they are willing to service. And so, okay, 7%. Yeah, that's what I thought. So that's increasing the rate on these conventional loans to where the rate between conventional loans and these non-QM loans is getting smaller and smaller, the difference, that gap. So before, yeah, you'll jump through extra hoops, right? It'll feel like, kind of doing blood work, or like it's, I'm pulling teeth trying to get all these documents from you, because before we were getting mid threes on your investment properties. Now they're getting up into the fours. And by the end of this year, they might be closer to 5%. And if it's only a 0.5% difference, but like these non-QM lenders don't need tax returns and business P&Ls and business tax returns, then they might start, shifting to those lenders more. So that's why I was thinking too, is like I myself might need to pivot to have better options and just be more comfortable brokering out these kind of deals to work with investors, because they are good loans. I mean, it's the kind of creative financing that you want. And I'm sure they're going to get better on their turn time. So it's not 60 days, 60 days to close. But I do think there's going to be an industry shift to more like non-QM. One guy, he actually started his own brokerage or his own mortgage shop out in like Colorado Springs. And he's like pretty adamant. He was like, dude, I think non-QM is going to take over the investment space because it's just not going to be worth it. And I mean, it makes sense because like Fannie Mae, Freddie Mac were never really intended to service the investor world, right? The primary directive of those groups is like to help bolster home ownership, not investors buying rental properties. Let's see. So what do you think of the interest rates in the near future? Yeah, going up fast. I think interest rates already hit where a lot of us are thinking the rates were going to go by the end of this year. So rates went up really quickly in the last 8 weeks. And some of that was, I think, the Fannie Mae announcement, but also, the 10-year treasury yield, which is what mortgage rates really follow. Whenever people announce like the Fed is cutting interest rates, like that's not really what factors into mortgage rates. You're kind of like seasoned realtors will know that, and then obviously your seasoned lenders. But we follow the 10-year treasury. 10-year treasury hit, what was it, like 1.6? I mean, the fact that it went, it's like 1.632 right now. It went up above 1.5, which is really where we thought it was gonna like finish the year at. So let me just pull up my chart. So just to give you some perspective, it was like 1.04 in January 26th, right? So 1.04, like the 10-year treasury is kind of like the baseline for all these mortgages. So the fact that it shot up between basically the beginning of February till, let's see, at the end of February, it hit 1.518. So it went up 0.5%, which is huge, right? It went from 1% to 1.5%. Obviously that was the biggest shift in the market, and a lot of people think rates are just going to keep going up because like it was kind of unsustainable how low rates were at. Like it's, nobody's making very much money on these mortgages. So that's why most people think rates are going to go up in the near future. Obviously no one's got a crystal ball. Don't hold me to it. Don't sue me if like you make decisions on it and rates go down. But for the most part, rates are probably going to continue to go up. Let's see, Annie, for those who are expanding their purchases, at what point do you feel it's a good time to switch from using conventional loans to these type of loans? Okay, when you're expanding your purchases, it depends, because how many, are you expanding from 1 to 3, or are you expanding from 5 to 10 higher? Yeah, 5 to 10. So I found out that actually at 7, there's a cutoff where you need a higher credit score, which might not affect everyone. It affects some people I'm talking to. But the reserve requirements start going up. But it's also like, how easy is it for you to put all your docs together, right? If you're like super organized, you have everything in a Google folder, like I'm going to ask you, do you have all your lease agreements? Some people are like, shoot, I got to go run to the property manager. I got to, and that's just a headache, right? That's just more tasks to add to your to-do list. So the trade-off really is how much of a headache is it for you? If you're super organized, I got some people, here's my Google folder with everything, right? Yeah, go conventional, you'll get the better rate and it wasn't that much of a headache for you. If you have 3 businesses and you deduct a whole bunch and you have 8 properties and you don't know where your lease agreements are, and you don't have the time, to deal with the lender hassling you on every single type of documentation, then go the non-QM route, right? Go to somewhere where they're just like, we're not going to ask you for your business tax returns or your profit loss, whatever. or your lease agreements, right? We're just going to look at this property. Oh, cool. It rents out for 1,000 a month and the mortgage will be 600. Awesome. We'll do that deal all day. That's, so that more depends on how organized you are and exactly where you are on your real estate journey. Because also when you start getting north of, like 7 properties, like you cap out at 10, right? On the conventional side. So you're probably already looking into portfolio loans. So we can talk about portfolio loans a little bit as well. Portfolio loans are usually going to be with a bank. Like you want to in or your local bank, because the local banks are going to be like, yeah, we'll do a commercial loan. We'll refinance your entire portfolio of 10 properties. And I mean, the rates are going to be right still mid fives, but we're going to do them all at once. And then it's like some people I've heard, and this is why actually I started establishing relationships with all my local banks here. And some of it's just like time as a client. Some of it's just how much in assets you have with them. But some of them, right, if you have all your assets with them and you have all your real estate with them and they know your portfolio pretty well, I was hearing people getting like in the 2s for investment properties, which is impossible on the market. But a bank, if you're just like a private wealth client, whatever, right, they're just like, okay, we'll make a little bit less money. We're not even going to sell the loan, right? We're going to hold the loan and service it and make money on it and make barely anything because we want to win your business and keep your business, right? So that's a different business model, and that benefits you once you're at like the 10 properties. You really should be looking at portfolio loans at that point, or even when you're creeping up to that amount. Are there investor loans that don't require 20% down? So actually, this is a common misconception. I got into it there's another Facebook group called the Burr group. Just for Burrs is pretty good. And people were asking about this. And actually, so 15% is like the Fannie Mae guideline for rental properties. So you can do 15% down, but you'll have PMI and the rates are terrible. Like the rates are actually, even at 20%, they're not great. Rates at 25% down are really great. I just sent somebody this the other day. But the difference between, okay, as of 2 days ago, this is where we were at, like on a 20% down, the rate was 4.5% with no points. But at 25% down, you're at 3.875 and you get a 1/8 point lender credit, 0.125% lender credit. So that's a huge difference in interest rate just by going up 25%. And so now, and part of this is just like I'm busy, and so I kind of like try to push off business, but I'm like, just save up more and get to your 25% and you'll have a way better loan. Versus, I mean, if you have like a sweet deal where you're going to have instant equity, right? Because it's going to appraise for 200 and you're scooping it up for 150, then sure, do 15% down because you just can't wait. And the deal is so good. Otherwise and the reason like the loans are structured this way, right, is like you really should not be that leveraged. And just from a philosophical standpoint, right, like 15% down, you should not be skirting by to get investment properties, right? You should be securing them comfortably with 25% down. So that bridge group, I was talking to them. That's who I sent the email to. Like, I'm having them. I'm like, tell your investors, like, do 25% before they buy your flips. That just puts you in a way better position. So you never have to like force liquidate your rental properties because you're tight on cash, and then now you're selling at a discount. So that's on the conventional side. I also saw some people were saying like, yeah, hard money lenders will do 10% down, but now you're paying like double-digit interest rates, and they usually they're short-term loans. Like you do not want to hold them. They might have a balloon payment, 6 months, down the road, right? Because you should really rehab it and get out of it in like 3 to 4 months. That's why you're paying double-digit interest rates, but you can get away with 10% down. I think I might have even saw some people doing 5% down. Now I know we have a commercial lending department, and they said they'll go to 10% down, but It's really based on how savvy or how experienced you are as an investor. So they have a couple different tiers that you can meet. And I can't remember. I always have, because I just end up referring people to our commercial branch manager anyway. Um, but the tiers, the two different ways they evaluate most borrowers on the commercial side is if you do, I think it was like in the last 36 months, if you've done like 1 to 4 deals, you're in like the bottom tier, right? And then if you've done like 5 to 7, then you're in the second tier. And if you've done more than 7 deals in the last 36 months, then you're in like the top tier. And that affords you more leeway, right? And better lending terms. So your rate's going to be better and your down payment requirements are going to be better. And then the other way they measure it is DSCR. So this is something I had to look up, right? Debt service coverage ratio. It's basically after expenses, how much are you covering your debt obligations, right? So debt service coverage ratio. How much can you cover the debt with the income? So if the DSCR, it used to be like 1.1, but they're getting tighter. Like 1.1 was the minimum, right? Your portfolio, they'll look at your entire portfolio. So they want to see, okay, you got 6 rental properties. Your DSCR is at least a 1.1, but now I think it's like 1.2. But if you can get up to like 1.5, then you're getting really great interest rates and really great terms on your financing. So that's a little bit too about the commercial lending options. And if you want to do less than 20% down, how do vacation loans work? This is a popular topic. I know you can do 10% down. What are the downsides versus a traditional investor loan? Okay, so vacation homes, right? A lot of people want to talk about vacation homes, and you can do an Airbnb because you're not allowed to get rental income from your vacation home, right? That's one downside, I guess, versus a traditional investor loan. And where you'll really get caught in this, I don't even know if you would get caught necessarily. Where it could raise red flags, because lenders are very particular about second home loans, is if you try to get another loan the following year, for example, and on your tax return, you're showing you're making rental income from that vacation property, right? That's going to be a huge red flag. I don't know if you're going to be, if the feds are going to go after you, if they even care. But that's where the red flag would be, right? So just be conscious of that. There's also a lot of restrictions on your second home. So like for example, I had somebody here in Kansas City who actually is almost like backwards. They live on the lake, one of the nearby lakes here, and they wanted to buy a property kind of close to downtown and turn it into an Airbnb and call it their vacation home. But the vacation home restrictions, and actually it doesn't, most people say like it should be 50 miles away from your primary residence. I've like tried researching this, and there's no actual like definitive like black and white in the guidelines like what mile radius it should be. And it just seems like from enough people, it's like it's kind of a gray area. But so one downside is it has to be far enough away from your primary residence, unless it's like weird things, like if it's on a lake, then it like almost every time like will immediately qualify as a second home, because it's like, oh, people want lake houses. So that's a way to get around it. And then, yeah, people want to do Airbnb, but also like you can't rent it out for more than, I think, like 50% of the year, right? So that's still another restriction. The rates, though, are way better on vacation loans. They're really second home loans, right? And second home loans, the rates are much closer to your primary residence almost. So because they're not expected to be covered by rental income, you should completely qualify for it based on your income alone. That's why I think, I mean, I guess I don't really know why the investors price it the way they do, but yeah, secondary home loans are a great option. You definitely, because like if you run an Airbnb like mine, like I don't even have 25% occupancy because I really just rent it out on the weekends. If you're trying to be aggressive with it, get something in like Florida and you're going to rent it out like the entire month. Like honestly, off the record, I guess. Shoot, I guess it's being recorded, but whatever. Like you probably won't get caught because like you're probably not reporting your Airbnb income on your Schedule E on the tax returns. It's going to go under like some business entity's income, right? And you're going to do some like it's going to be on your business tax returns. And like the fact that like would it get traced back to your second home loan? Like probably never. Like no inspector goes and like looks and verifies like, oh yeah, you stayed down there less than 180 days, and like you also did not rent out the place for more than 180 days. Like it's just one of those things where it's like it's a rule. Will you get caught? Probably not. But also like as a lender, like we're probably more at jeopardy than you are. Like our license, if they're like, hey, you're doing a bunch of second home loans, and then they're like, we get audited, and then the clients come back to us and then on their tax returns show it. Like if more than anything, it's like, hey, we're the ones, our license is at jeopardy because we're pushing these second home loans to people where we know their intention. If it's one client out of 100, accidents happen. You could be like, yeah, they never told me they were going to plan on Airbnb-ing it. But if I did 20 of them in a year and they all turned into Airbnbs, then they're like, okay, this is not on accident then, right? But that's like the vacation home loan stuff. I mean, I want to do one. I think it's awesome if you legitimately use it as a second home, and then it's like, I mean, you can make like you really, and this is also where the rules, right? It's like you're kind of playing in the gray area because it's like you're not going to put it as a rental necessarily. The language makes it seem like if you're not doing it on a lease agreement, then it's fine to put it on something like a VRBO, an Airbnb, right, and rent it out by the day as a short-term rental. And that's where it gets like a little finicky. But there's definitely like plenty of blog articles and people talking about, doing a second home loan, doing 10% down, and then even if you Airbnb'd it 50% of the year, you could probably cover your year's worth of mortgage, with your Airbnb income. But that's definitely a good way to go. I mean, and then of course, like the most like tried and true, I guess, or like the simplest, most, if you're not being like super aggressive, you're okay getting like a property a year, right? The best way to do it is, you buy a primary home, right? 3 to 5% down, then you live in it for a year. And then after a year, you like decide to move, right? For whatever reason, then you go buy another home as a primary, do another 3 to 5% down. But then your first home becomes your investment property, right? And then you just rinse and repeat every single year. You get a new primary residence at 3 to 5% down, but then your old primary residence becomes your investment property. So now you've got your investment properties with 5% equity because they were original primary residence. That's actually what like that before I became a lender, before I knew about Burr and Airbnb, I was like, that was kind of like my strategy was, okay, yeah, I'll just like acquire primaries and go nice and slow. Just do, the thing though is like, you can't, right? That's why I say 1 year is like, you can't 3 months later go, oh, I want another primary, because that's going to, raise flags, right? Like the first one won't, but the second one, you'll be like, whoa, you just closed on a primary 3 months ago, and now you want to close on another primary. That's going to cause red flags again, more for the lender than for you. Like, the whatever CFPB is not really going to be going after you. It's going to be going after like, hey, Mr. Lender, why have you done a bunch of primaries on people that move and buy another primary? If you do it, well, again, 1 out of 100 clients, like no big deal. You didn't know that client was going to leave that house super soon. But if it becomes a pattern, then like the lender gets in trouble. So that's like another fine line to walk, but most people agree. Well, and FHA will say like 1 year, right? As long as you live in it for 1 year. So that's kind of like the industry quota, like unwritten rules. As long as you live in it for a year, people change their minds, right? Like you want to move to a different neighborhood, or, you want more space, you want a place with a yard, like your needs change. That's super understandable. the only workaround is like if you have a forced move from an employer. So the VA borrowers are a perfect example where now, you know, they can buy a house with 0% down. 2 months later, I mean, or 2 weeks later after they close, right, they could get orders to be moved to another base. Then, so there's an entire group that I'm actually a part of as well, where they're kind of educating these military veterans on like, hey, or even active duty, like when you move, don't sell that first place, turn it into a rental. Now that your second city, you get another property 0% down, and then you get forced to move again, and then you have a one-time restoration of benefits, and your benefits can, for most people, can get you about 2 houses. So it's like you get 2 houses, you restore your benefits, then you move again, you do another 0% down, and they're getting like, some of these guys are getting like fourplexes, like fourplex, 0% down, rent out 3 units, count the rent for your income, and you're getting guaranteed, you know, military income. Like I was like, the military guys, if they're doing it right, and that's why I think that's such a huge piece, is like educating people. If they're doing it right, I mean, they could be getting fourplexes every single time they move, and each of those fourplexes is like cash flowing like crazy. And they're just doing like one after another, and they'll get like, I got one client, they got like 4 4plexes, which is, I mean, it's beautiful, like their portfolio. I would love to have that many fourplexes. With the buy, primary, switch, aren't there additional rules if you're moving to a similar house with the same city? Yeah, so that's why I was like, the 1 year thing, right, kind of gets you away from that. I was like, and they typically, they don't like to see you downsizing, right? So if you go from a 250K house to a 150K house, then it's like, oh, are you really moving, or are you just playing the rental game, right? But if you live there for a year, then no one's really going to say anything. But that's one of the red flags. Again, a one-off is not really gonna get you in trouble, I don't think. But like, again, it's a pattern, right? If it's a pattern, then, I mean, primary residence claiming or misclaiming is the number one like mortgage fraud that exists. But again, I think that's still, you know, they're mostly going after the lenders, not the borrowers. And so it's our job to be like, well, are you really going to live there? You know, like, what's your intentions? So a lot, sometimes too, like, you know, tell people, it's like, okay, if you want to Airbnb it, like, cool, just don't tell your lender, right? Like, we want to be ignorant. Like, don't email it, don't text us, don't put it in any written record. If you're going to get a second property, just get the second property as a second property. And then, you know, if you choose like, oh, this might work out as a part-time rental, then sure. Is that group vetted VA or something else on military? Oh, okay. Yeah, it's called Active Duty Passive Income is the group for military. It's really cool, actually. So the guy that started it is, I think he's still active duty, actually, and then he started house hacking because he was looking for more ways to kind of, right, get additional income. And that group has grown to like over, I think, like 20,000 members right now. But they have like, so you might not get approved directly because they actually vet all their, you know, they want to make sure the people joining the group are like legit, and so they might take a while to approve your membership. But yeah, Anna, definitely hit up Active Duty Passive Income. They have a bunch of free resources. They have their website too, and I think it's cool. Like when you search for, I think like VA loans on YouTube, like one, you know, their video is like one of the top ones to come up. But yeah, that one's a huge resource because, you know, a lot of veterans go in there or active duty go in there asking for, you know, help on, right, what to do if a tenant doesn't want to move out or is giving you troubles, or just different real estate questions. I mean, it's a nice kind of forum to get in and just, I mean, kind of like SARE, like, right, just a good group of people that are helping other people, and you can get good information there. And it's a community of like-minded people with similar backgrounds that want to all help each other. So that's another great group too. But the VA house hack is like, man, I'm just, honestly, it makes me want to enlist even as like a reserve member, just so I can get that VA benefit, because it's no joke. I mean, the rates are really great. You know, for 0% down, no PMI. Like and yeah, you can go up to a fourplex. Like if you're doing it right, you should definitely go fourplex. It's just, the numbers work out the best. You get the economies of scale, whatnot. But I mean, even you could settle for a duplex. But that's definitely the route I would go. Oh man, any other questions? Or shoot, I've talked about cash flow loans, bank statement loans, portfolio loans. Talked about hard money. I don't know. I could talk a little bit more about like the Burr method, I guess. I don't know how yeah. So is your favorite strategy Burr of all the ones? Yeah. So the Burr is really beautiful. And basically the magic number is like 75% of ARV is what you want to target, right? Like, so when you think about your purchase and your rehab costs, should be 75% of the ARV. And like, I've got this client, they're like doing it textbook in, I think it's Topeka. It's Topeka or Lawrence. I think it's Topeka. They actually like, they're like buying the block. Like a bunch of their properties are on the same street. But basically, yeah, they'll buy a property and it's almost like, it's super easy too, because it's like almost each one of them is like worth 100K after. And so they're buying them for 50. They're putting 25K in, right? So they're, and actually the way they funded it was a HELOC on their primary. So their primary is worth, like say like 300, 400K. And it's like, and these two, the couple that is doing it, they make pretty modest, incomes. Like they're both like W2, I want to say like, I can't remember exactly. They're like 60 to 80K in income a piece. So like not like huge lawyers, doctors, whatever. But they've built like a beautiful real estate portfolio through the Burr method because they paid down a bunch on their house, right? Then they took out a HELOC. That HELOC was like 100 grand cash. They put 50K on the purchase, 25K on the rehab, right? So that 75% is the magic number. Like if you're gonna Burr, make sure your total cost, like you probably want to budget like just 70%. So you have 5K buffer room, because our limit on the cash out refi is 75%, right? So if it's worth 100K and we can do the cash out for 75K, like I'm not writing them checks. Our company is writing them checks. It's cool every time they close, right? They're getting almost the 75K minus like the closing cost. So they're getting about 70K every single time. And then they get that 70K back. And right, it could go back into the HELOC, but they're just paying the HELOC and they will roll that 70K into the next project, right? And the next project. And so like you're recycling that same 70K. And in their case, they took it out of equity from their house that they already owned. But that 75K, instead of, right, when we're thinking, okay, I want the lowest down payment possible on multiple properties, right? Like you're at the end of the process. So you have to wait 6 months to do the cash out refinance for seasoning, right? You buy it January, 6 months later, you refinance it. You can do it sooner if we prove you bought it with your cash or HELOC funds, like that works, but you're capped at your purchase price. So your cash out limit before 6 months would be that 50K purchase price. But after 6 months, once it's seasoned, you can do it based off the ARV, which is 100K. So I just had someone email me today and their ARV was like 250 or something. Their purchase price was like 150. So I was like, wait 6 months and then we can do the cash out and you can get more money out of it. But that lets you, right? That's the repeat of like the buy, rehab, rent, refinance, repeat, right? Once you repeat that, you're using that same 70K and you're buying another property. And then also like, you're going to find better deals if you're buying fixer uppers that you can pay for in cash, right? So like, honestly, like most people, it's like, yeah, the goal should really be like hustle up and save up like 75 grand. Because once you hit that 75 grand, whether that's through equity in your home or savings or whatever, you can redeploy that over and over again, right? So you just repeat, rinse and repeat, buy another property. And so like it's amazing. Like this couple's got like 6 or 7 properties on modest incomes, right? They got a nice house and they're just refinancing, they're refinancing, getting their money out. And then they're like, yeah, like we got another, they're like, we have another deal coming up where the guy wants to sell a package. We only want one of like the 4 properties he's selling because it's on our block. And of course they're going for the buy the block strategy. So yeah, that's one of my favorite strategies, just because the way I've seen it work is like, and then we also count 75% of the lease agreement. We can use more based on your taxes if you're not deducting that much off your rental income. But the cleanest, easiest way is 75% of your lease, right? The way why it's so beautiful on the debt to income side too is, so, say your mortgage is 600, right? And your lease is 1,000, right? We take 75% of that lease, which is $750. Instead of adding it, so if you think about your debt to income equation, if your debt is 1,000 and your income is 2,000, and we add 500 on your debt and 500 to your income, that actually, that helps your ratio, but it's not the same as the 500 in income from this lease agreement actually completely washes out the debt on the new property. So your debt income on the DTI calculation does not actually go up. We just look at, so your net income on that property, for in this hypothetical example, right, where the mortgage is 600, 75% of the lease is 750. Like your actual net income is 150. So instead of 1,000 plus 600, and then your 2,000 in income plus 750, right? We're just doing your 2,000 in income plus 150. We're just taking that net profit differential on that property. So every time this couple acquires a new property and refinances it, their DTI gets better. Like, and so that's why I was like, man, this is like the most beautiful thing. Like it, like you could just keep acquiring more of these properties with the same 75K, and your DTI is getting better with each one, and you're recycling the funds. So you're not really, it's not like you're buying a bunch of 100K properties, 20 grand here, 20 grand here, 20 grand here, right? Which is what a lot of people end up doing. And if you're willing to go through the BRRRR method, the only thing, right, the only catch is like you have to be savvy with contractors. You either should have experience yourself, or you should have a trusted contractor who's not going to blow you up, because of that 25K turns into 45K in rehab costs, and your costs get overblown, then you're only refinancing 75%, right? You're getting 75K out, but the whole transaction costs you 95K. Kind of, it's, I mean, you'll still probably come out ahead, but it's not as clean. Construction loans are, honestly, I don't do a ton of them. I should, because like they're building new houses and new subdivisions everywhere around Kansas City. Construction loans are just tricky though, because I mean, they take a long time, obviously. And then there's a variety, like you probably want like a one-time close OTC construction loan if you're looking into that route, right? Where instead of, sometimes you'll do the initial loan, you'll have to close, but then you have to close again, like when the property actually finishes. And so they rerun your credit and they recheck your income and yada, yada. And then, so like, shoot, if you lose like your job in the middle of all that, like that's a terrible situation, because then it kills the loan, and you've probably spent like a pretty penny on that loan process, because it's multiple inspections, multiple appraisers. You're probably putting up some money up front for some of the construction, or just some items here and there. So construction loans, yeah, like I know the one-time close loans are popular. I mean, shoot, that's probably my like shallow, just because I don't do a ton of them. If you have any other questions on construction loans though, like, I work with people that like specialize in construction loans. If I were to do one, I would actually have to partner up with one of them and like split the commission with them, so they could kind of, walk through the process. Line of credit on stocks. I'm not too familiar with that. I know like trading on margin is doable. You got 100K in stocks, they'll let you trade right up another 100K. I don't know about pulling that money out and using it for real estate, but yeah, that's, I don't know. I haven't run into too many people doing a line of credit on stocks. Seasoning requirement for a cash out refi. So our seasoning requirement is the Fannie Mae guideline. So it's 6 months. That's going to be every single conventional lender. Some of them might have more. I guess the reason why some people get mixed answers is because lenders will have what's called overlays, which are their requirements that they impose on top of the Fannie Mae, Freddie Mac guidelines, right? Those are kind of the baseline starting point. Like we can't go less than that, or else we couldn't sell the loan to a Fannie Mae investor. But we can always add on more, right? So like 500 FICO is the minimum on FHA, for example. But a lot of lenders will be like, we won't touch anything below 580. So they'll tell you our minimum is 580. And then so same thing with like seasoning. It's like they might tell you their seasoning requirement is 9 months or a year, but the minimum that you would hear is 6 months, unless you're dealing with like private money lender, and then you end up paying for it with a higher interest rate. And that's the non-QM stuff that I was talking about. I don't know if Angel Oak, let's see if they have like a cash out refinance. I don't know. They have some like portfolio loans, so you might be able to do something with that and refinance it sooner. But 6 months is going to be, for the most part, what you're going to run into on most your deals when you're talking to your traditional retail lender. Having to lease out your rental for before you can start counting it as income, or is it? Okay, so counting rental income to qualify for the mortgage is typically dependent. Like you can have just a lease agreement, or it doesn't need to be leased out already if you have on your tax returns proof, or you have like property management experience through your job, right? If you're a property manager for an apartment complex, we could probably count it, because the appraisal on an investment property comes with a rent schedule. I think that's actually why investment property appraisals count like are more costly, or cost more. They're like $700 instead of $500, because the appraiser has to do a rent schedule where they look at all comparable rentals in the area, and they, on top of establishing what they think the market price is, they also establish what they think the market rent is. And so we don't necessarily have to have a lease agreement if we have the rent schedule and we have proof that you've been a landlord. If you don't have proof as a landlord, actually, then the lease, we can use the lease and the rent schedule from the appraisal, and then we can count it. But that limits you to only by being able to buy a property that currently has a lease, or like will have a lease in place by the time you close. That's why you're going to be, it's going to be tougher, because like a place that already has a tenant is going to be more attractive. So you're going to be, competing with more people, right? And that's going to jack up the price, but it lets you use that rental income. Angel Oak doesn't have seasoning requirement for cash out refi. Yeah, so that's like the private money lender exemption, right? Of like, they're not Fannie Mae, Freddie Mac lenders. They're not doing a conventional loan, but their rate's going to be 1% or 2% higher. And then that also, I touched on it. Like you can, like technically we can still do a cash out refi before 6 months. So I'm doing it right now, where like this couple, these are like some doctors in Las Vegas, where they bought 3 properties, $50K a piece cash. And all they want, they just, they didn't rehab them. They didn't do anything. They're hoping the appraisals came back kind of low, but they just want their cash back. So they're not doing like this, like this 6-month season thing where they want to get back their rehab costs because they don't have rehab costs. They just bought, these properties, they're like 50, 60K or 50K a piece. Their rents are anywhere from like $550 to like $650. So they're all 1% deals. And they bought them in December, and we started, when we're about to close on the refinances of these. We started these last month. So it's called delay. If you want to Google it, it's called delayed financing. And I actually might even have, I keep these tabs up a lot. The rules on delayed financing. So there's just a couple of things you have to keep in mind. You can just look it up. It's like, if you type in like Fannie Mae seller's guide, delayed financing, you'll see all the conditions you have to meet. But did you buy it in cash, right? Like that's yours, like, because we're going to try to find if there's a hard money loan. HELOC cash is fine, but we just got to trace the cash back to you. If it's your cash, there's no loans against it. We can do the cash out refinance before 6 months. And again, but the delayed financing rule is only up to your purchase price. So you can't use the ARV in that example. Again, Angel Oak might let you, but that's because they're going to charge a higher rate. FHA loans used as an investing strategy. Yeah, going for a fourplex. I mean, if I could do it all over again, it depends on when. There's usually 2 years for rental income to count. So just really quickly on like the 2 years, Nelson, that means like you're saying lenders want to see, because we count rental income, I guess, from your like businesses as long as it's been established for 2 years. But rental income on a subject property is, I guess, what I was talking about, was like the ways we can count it, and we can count it towards that mortgage. As far as, but yeah, the FHA, fourplex strategy, yeah, definitely. If I could do it all over again, like instead, I mean, 6-bedroom house is like cool, but the 4-unit, yeah, the 4-unit FHA strategy is really good, because you're essentially, you're going to cash flow from day one, right? If the other three, the perfect situation you walk into, right, 3 units are rented out, so you can count. Well, yeah, you can count that, I think, with your rent schedule and active lease agreements. So you can walk into it and it's going to be cash flowing. And then you have to live there though for like at least a year, unless you have extenuating circumstances. Like I think like having a baby qualifies, or like getting married qualifies, right? You marry someone from another state and you got to move. Like you got to just have like a legitimate reason, other than like, oh, I changed my mind, I want to turn this into a rental property 6 months later, and then so you can go buy another fourplex. Like that's where it's going to raise red flags. So it's a great strategy. Definitely a really good way to start, especially because it'll start jacking up your income too, like your side income. If you just fresh out of college, like what I would recommend, right? Like before you can get into the burr, is you should get into the house hacking and there's tons of like good YouTube content and articles on house hacking. But yeah, buy the fourplex, renting out 3 units, living in one like essentially for free, and then you're saving up money for the down payment on the next property. Live there for a year, then go get another fourplex, and then you can do that every single year. And then after however long, like 5 years, you got 5 fourplexes. Like that'll be pretty good. Mortgage products used for small apartments, 5 to 20 units. That's definitely going to be your commercial products, right? Because anything 1 to 4 units is in the residential world. Beyond 4 units, and it's a commercial product. So it's definitely going to be a commercial loan. You can technically use like an SBA loan as well. And SBA loans were interesting because I don't know if it's still the same. I did like a couple seminars, and they're saying they're doing like 10% down for SBA loans, and they were actually waiving like the first 6 months of payments, like the government was covering as part of like the pandemic relief. So I don't know a whole too much, about that. I just know like our commercial department. It's essentially going to be a commercial loan, commercial real estate loan, and a lot of it's going to depend on like your DSCR, the rate ratio I was mentioning earlier. What's your debt service coverage ratio? How much of the debt service, how much of the mortgage can be covered by the rents? There's just so many variables in that, because it's very much asset based, right? So also if it's like a fixer upper apartment complex, you're going to be talking essentially to the same lender. It's still the commercial lender, and it's more like, they're like a matchmaking service, right? So our commercial lending department has 60 plus lending partners that they have, depending on the type of borrower and the type of project, right? So type of borrower, and almost all of it's going to be an LLC, probably with a personal guarantee, but it's going to be, just based on how experienced are you, how many deals have you done, that'll affect the rate. And then the DSCR will affect the rate. They want your credit score to be, I think, at least 640 or 680, but that's really just like a check the box hurdle. Like it's not quite the same, like where we are very, on the residential side, we are very sensitive to like what's your FICO score, like every 10 points, and we have a different bracket for what rate you're going to get. For them, it's like, oh, okay, like your credit's decent, good enough. Now let's talk about the property, and then they underwrite the property. So you definitely, yeah, just want to talk to a commercial lender. I don't even know if, like, when you say like the best mortgage product, right? Like it's really the type of lender that they broker it to. Right. So like our commercial department, the 65-ish, whatever lenders they work with, it's like this investor really likes super savvy, super savvy real estate investors. They're offering the best rates if you've done like 10 plus deals and it's a killer cash flowing apartment complex deal, right? Whereas you have other lenders that's like, oh yeah, no, we like going after, the new guys, we're charging crazy high rates, and it's for the person that's like just wanting to get started on an apartment complex, right? It's their first one. So you have different lenders, and I don't know if like they call their mortgage products different names, right? That's at the end of the day, it's all still just a commercial real estate loan. And that more is going to just depend on, lender to lender, like who you're using and how many connections they have to how many different investors, and if they can pair you with the right lender, not necessarily the right product, because the products, like I said, at that point it's kind of like the Wild West. Like there's no, to give you, I guess, some background detail, like you don't have to be licensed to be a commercial lender. Like I had no clue until I started talking to commercial lenders. Like, the way I describe it now, right, it's just millionaires lending to other millionaires. Like they don't have licenses. There's no hard and fast rules. There's no like guidelines. Like it's just, okay, what kind of loan, what loan, how much money do you need for what kind of project? And then for them, just going off of that. Book recommendations.
Hey, Alex, I don't want to interrupt you too quickly, but we're over an hour. I don't want you to have to keep talking if you don't want to. So you're welcome to just shut it down after this, since you've been answering us for like the last hour. So
no, it's awesome. Yeah, appreciate it. Yeah, I'll probably wrap it up here soon. I got pretty much wrapping up my night anyway, so I'm happy to keep answering questions. It seems like the questions have kind of died down. Like book recommendation on real estate financing strategy, I know like Bigger Pockets put out the Burr book, which is like, I don't know, I guess it's a lot of people's Bible. Like you could go for that one. I actually haven't even read it. I just, just from talking to other investors and obviously doing the financing for them on the Burr side, it's kind of enough for me to get it. And then actually, I joke, like when people ask me like, what kind of like books did I read, like even before I started buying real estate, I was like, I didn't read any books. Like I totally flew into it, and like I still like the books I read are more like, I don't know, I got like random, it's like self-help books, like business books, but they're not real estate books. I have a couple like that I've gotten at like the thrift store. It's like real estate tax loopholes or something. I'm sure I'll refer to those in like the future. Best way to reach me here, I'll type my email, but I'm also like on Facebook. It's like Alex Chang. If you just want to like connect with me on Facebook, and then mtg.com. And actually, I guess just between, I'll just put my personal email on here too, because my professional email, if I change companies, might go away. So I'll leave my personal email as well. Yeah, I guess Preston, yeah, glad I was able to be a little bit helpful. Honestly, I didn't know what to expect coming into this. Other than like, I hope people have questions, and I hope I'm not just like,
oh, there's definitely going to be questions. It always is. Yeah. Thanks for dropping your info, and I think people can reach out to you. But yeah, thank you again so much for your time. Is there anything else you wanted to drop some gems on us before you headed out?
Any other gems? No, I think my best gem is just like, I was like, if you don't know what the Burr strategy is, look into it. I think most people already do. Thank you, Annie. Yes, I kind of like realized, I was like, man, maybe I shouldn't have scheduled this on my birthday week, but I was like, it's a good opportunity.
Well,
So I wanted to do it because I was like, next year I'm not scheduling anything for my birthday week, and I'm probably traveling somewhere overseas where I'm unreachable. And I was like, I don't want to deal with work stuff. Like had to deal with emails yesterday. But yeah, no, appreciate everybody for sitting in with us and taking the time.
Happy big birthday. Big birthday boy
thank
here.
But hopefully I can connect with you guys on Facebook if we haven't already. I'm always answering freaking Facebook Messenger questions. I call it 20 questions with like investors every day from all the investment groups. So feel free to like shoot me a text, or I guess I can drop my phone number as well if you guys want to like text me. But yeah, no, really glad to connect with everyone. Yeah, that's my cell. It's great hanging with you all, and hopefully we can do an in-person meeting one of these days. We'd love to meet you all in person, but yeah, let me know if you guys need anything else.
All right, bye everyone. Have a good night.
Bye-bye.